Broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everyone. It's Bobby Rains here for our once every 3 weeks members-only workshop. Happy to talk to you all today. Let's go ahead and get started. All right, so we have our usual agenda here. We're going to do our market update, a little light foreshadowing, and then member-driven content, questions, site demonstrations, any sort of questions you have about things like that. And as always, a reminder that if you send in questions ahead of time, I can work up fancy slides that have answers to your questions if it's something that you'd like to see discussed in a little more detail. All right, with that, let's get to the market update. All right, so I did something a little bit different this time. This is the Dow Jones. It's 2 years of one-day candles. And the dashed line is where the market was when the final vote was taken on the tax bill in 2017. So the tax bill was supposed to accelerate the economy higher. Obviously, the stock market is not the economy, but the Dow is not far from that level. The S&P is higher by dint largely of having some smaller companies. It's not just the big 30. It's got the 500, so it's a little bit less exposed to trade than just the biggest 30 companies do. And then also bond yields. So 10-year bond yields are now well below where they were. Bond yields typically go up when people are expecting growth going forward, and they go down when people are looking for safety. Right? You'd be happier with a lower return. If you expected the economy to be rocky, you wouldn't be willing to lock up your money at some sort of fixed income return at a low rate if you're expecting a lot of growth. So yeah, those are the market charts for this week. If you want to look at the support and resistance levels, I would advise you to look at our Friday blog post, which you can find in the Market Intelligence Center section of the website, and then we can review. We put together some charts with support and resistance levels for all the major indices. In those cases, we just did the S&P 500 this week. Sometimes things are pretty much the same. All right, so moving on, those growth expectations are starting to be lower because of trade. Everyone is starting to price in a longer trade war with China. We haven't even heard that talks are ongoing for a while, much less that talks are productive, which was the mantra for about 6 months. And then there's also, it looks like automobile tariffs on Japan and Europe are on the table also, which they would, in addition to making cars more expensive, would almost certainly be met with some retaliation there. We have the debt ceiling deadline early in June. I haven't heard much about it. I'd like to think everybody could be an adult and just raise the statutory borrowing limit, but we will see how that goes. The Federal Reserve meets in the middle of the month. It'll be kind of interesting to see what happens. The job market remains pretty strong. The employment side, there's no real reason to cut rates just based on the employment data. But will they try to match the bond market in terms of if rates are going down and the sort of bond market controlled into the curve? Will the Fed feel like they need to move the shorter into the curve that they control down as well? That is sort of a thing that we'll be watching. And then generally it's some of the data that's come in is softening, but the economy is still strong overall. We'll get employment numbers next week. That's always an important one. But there's nothing has come in that has been really, really off trend. If you looked back at the last 10 years or so, you'd see sort of the same trend. It's not a straight line. It's a wobbly line, but things are still pretty much on trend, although I will say the last couple of reports we've gotten in a couple categories have been to the low side of the trend, but that's not in itself alarming until we get a few reports in a row that start to look like that. All right, and then finally there is that thing across the pond, as they say, that rhymes with Trexit. I promised I wouldn't mention it for a while, and I don't have any update other than to say that there's some maneuvering that's starting to happen, but still no actual progress. That remains a speed bump on the path to global growth for sure. Trade barriers tend to be bad for growth. Yeah, so that's the slides. We are working very hard on a big project that we're going to be pushing out later this year. We're all very excited about it. I think you guys will like it when you see it. We don't have a launch date or anything just yet, but I did want to sort of tease that a little bit. And we'll send emails and let everybody know when things are happening, and we'll do some webinars and stuff like that to get everybody prepped and ready to go when that comes out. Show off all the new stuff and explain how it all works. So that is the prepared portion of the presentation for this time through. The rest is up to you, the listener. I'm not sure what subscription you have currently, Daniel. We're actually going to be simplifying things. No one's rate is going to be changing, but we'll be sort of moving our things around. So probably not is probably the best answer to that question, which is, will the new stuff be a separate subscription? Depending on where you're at now, you will probably just be getting more stuff than you are currently. Jeff, I'm not sure exactly what you mean by that. We do intend to keep all of our portfolio services operating as best we can. Yeah, I mean, that's the plan. UTX is not doing great. We closed KMB today for a full profit, and there's some other ones that are plus or minus break even depending on the day. Yeah, we can also do we can do some put diagonals if things were to become truly bearish. It's been a pretty orderly decline over the last couple weeks as far as that goes. But yeah, I don't have any intention to stop putting trades in portfolios right now. The frequency may slow down, and we may be looking at slightly lower returns than we're able to get in different kinds of markets. But as of now, I don't see any real reason to just shut things down. Yeah. So Brian, so Brian's question is the last few weeks, the trade picks, and he's talking about the personalized trades on the trade idea generator for bullish put spreads was already at a loss based on the opening price. Do we have any recommended adjustment? So there's a couple things you could do there, Brian. You could move the strikes down to find something that has a similar credit. You could also just take it at that level and get a much bigger credit. You do obviously need the stock to go up at that point in order to make the full profit and not have to leg out of that. But that is another possibility there. And then I mean the other thing is, and the portfolio hasn't done terribly, but this is not. This sort of volatility, the strategy that we employ here that actually becomes the hardest to trade is the vertical spreads, just because there are sort of no second chances on those. So you can try to look for bearish ones, or try to look for ones that are a little bit further out of the money. If things are down in the pre-market, that may not be a good trade that day. We don't really have the ability to adjust things on the fly like that for all of our trades across the various platforms. So just sort of stay away is another option there. Certainly if it was a portfolio trade and that was the case, in most cases we would say either do this for a bigger credit or change the strikes, or just take it off the board and say don't do anything. We've canceled trades in the pre-market before. That's certainly a thing you can do. This kind of market gets to be tricky because a lot of the action tends to come overnight, so you get a lot of weird gap opens and things like that, and it's hard to guess the night before what the next day's open is going to look like. All right, so Brian has another question. He says, do you expect stocks to have built in the trade war now, or do you think substantially more decreases are coming? That's a good question, Brian. I mean, it's possible both of those things are true. I mean, the efficient market hypothesis would tell you that all the available information is baked into the price of a stock right now. That's not 100% where I fall on that debate. I think, if you look at pretty much anything, stocks tend to sort of overshoot to the upside and the downside in terms of expectations. Also, there's the issue of how much more information is coming. If we get substantial, I'm not sure exactly what else China can do in terms of retaliation there. But also Japan and the EU, and certainly we could probably, if we tried really hard, invent new things to pick trade fights about. So it's really a function of how far do things go. And I don't have the crystal ball and able to be able to predict the political situation. And in terms of, I mean, if you think everybody's, trading stocks down because they think earnings are going to be lower in the future, how much lower do you think earnings would be? Gets to be really, really complicated. All right, so at some point, company supply chains would be affected. Is it likely we would have a minimal bounce back based on previous trade spats? There hasn't really been a trade spat to this degree since I've been doing this. And the world is, I think, very different since the last time there was a trade spat to that. So I don't really think there's a good model from history to be learned. But yeah, I mean, at some point, supply chains will adjust also, right? People can move production away from China. I'm not sure how moving production from China to Vietnam helps the American worker, which is nominally the point of all this trade stuff. But yeah, I mean, it's really hard to know. There's too many moving parts to really model it effectively, or at least for me to model it effectively. All right, so what are your thoughts on possible recession? Do I think we're close to yield curve inversion? The yield curve is already inverted. The 3-10 spread, I believe it is, has been inverted and sort of getting worse for a little while now. That tends to portend a recession, but sometimes it can be 18 months before that actually happens. So it's yeah, I don't know. And those sort of indicators are always the sort of thing where it predicts every recession until it doesn't. So certainly that's not great, but it's not. It's hard to trade that just because. How do you trade something that might happen next week and might happen 18 months from now? It's kind of impossible. You got to just sort of stay in tune with what's going on and sort of look at other things. It's certainly a caution flag, let's say, a reason to not just go long and forget about it. But it's also not I don't think you can really do a lot of defensive strategizing right now. All right, I don't see many more questions coming in, so I'll go ahead and start to wrap things up here. We will, as always, put a link to the slides and a copy of the recording on the website tomorrow. And we'll send you an email letting you know when that's ready, and then we'll have our next one in 3 weeks or so, which puts us at about June the 19th. Yeah, so I will talk to you then. If you have questions or concerns or what have you, feel free to hit the web button or the help button on the website, or give us a call. Before then, don't feel like you have to wait until these sessions to hear from us. And yeah, read those. There's a Monday, or in in the case of this week, Tuesday. Post that goes up about sort of the outlook for the week ahead, and then we have one on Friday that wraps everything up as well. And those are good commentaries to get a hold of between these sessions. All right, thank you all for coming, and I will talk to you in 3 weeks.